Calling all do-it-yourself ETF investors. Do you want to ring the bell at the Toronto Stock Exchange? Join us for ETF Investor Day, our first ever in-person event right here at the TSX on Thursday, February the 8th.
This investor education event will be focused on empowering Canadian ETF investors and providing informative content to help you navigate markets in 2024. There's going to be 3 exciting educational panels, which we've curated specifically for our ETF Market Insights audience. Our insightful guest speakers, who are ETF industry professionals, will provide you with the information and education you need to confidently manage your investment portfolio.
This will be an amazing opportunity to learn from ETF industry specialists and to network with like-minded investors while expanding your investment community. You won't want to miss this event.
Register today at etfmarketinsights.com.
We look forward to seeing you here with us in Toronto.
My name is Daniel Stanley. I'm an ETF specialist at BMO Exchange Traded Funds, and I'm joined today by my friends and colleagues, Chris Heakes, who's portfolio manager for all of BMO's equity and multi-asset ETFs, and Sohrab Movahedi, managing director, financials research at BMO Capital Markets. And today we're going to cover the recent bank earnings announcements and what they mean for investors and the Canadian economy, as well as looking at different ETF strategies that give you exposure to the Canadian banks. So without further ado, Chris and Sohrab, thank you for taking the time to join me today. And Sohrab, I want to start with you. You know, I'm not a superstitious person, but it seems fitting that this is our 13th Canadian bank podcast. And I think it was last week, Scotia came out of the gate with a big EPS miss versus consensus. Can you talk to us a little bit about that? And in general, how did the banks do this quarter?
Hey, I'm not superstitious either, but wow, 13. Hopefully we have 113 in us, Dan. So it's good to be back. Yeah, you're right. The fourth quarter earnings kicked off a little bit over a week ago, I guess, with Scotia. Scotia would have been the low point. So that's, I guess, the good news. I think it improved thereafter with the rest kind of reporting. And I think the stock price reactions probably to the results being appropriate and warranted in all cases. You know, across the big 6 banks, the operating earnings, and this would be earnings to common shareholders, I'm talking about, so after prefs and the like, those came in at around $13 billion. So that's a big number for the quarter for the big 6. You know, it annualizes to 52 billion plus. That's the good news. But the bad news is it was the 6th consecutive quarter of year-over-year earnings decline across the industry. Obviously, that's not consistent across every bank, but it just gives you a sense of the type of environment kind of we've been calling over the past year and a half. Really, the issue has been credit, not so much because credit costs are skyrocketing, but because they are normalizing. And they're normalizing from very abnormally low levels post-COVID. There was massive reserve building, really off the charts reserve building, obviously a prolonged period of kind of low-ish, abnormally low-ish PCLs. And then you have that normalization in credit at a time that inflation has been quite persistent and bothersome, if you will, to the expenses, and revenues are feeling the impact of a coordinated global effort to slow down economies to fight inflation with rates being up and what have you. So, you know, I think when you don't have the top line and you have this drag, you know, both on expenses and on credit, it kind of lines up to something a little bit negative, and that's what we've been feeling from an earnings growth perspective across the industry. I think some of the banks that have done some acquisitions have been able to deploy capital relative to the other ones will be better positioned. but we're really thinking of the next, call it. So across the big six banks, operating earnings to common shareholders came in around $13 billion. So that's a big number, even bigger when you annualize it for the quarter, north of 52 billion on an annualized basis. And those would be operating numbers, obviously, but that's the good news. The bad news is it was the sixth consecutive quarter of year-over-year earnings declines across the industry. And of course, again, it wouldn't be uniform across every one of the banks, but from a system-wide perspective. And the culprit here really is a normalization in credit provisioning levels. We had gone through an off-the-charts type building of reserves in response to COVID. We've had a period of abnormally low loan loss reserves as those numbers were coming down, banks were drawing down on them, and now we're going through a period of renormalization. Nothing, spotty, nothing spiky, but it's just, you go from 35 basis points to 37 basis points to 40 basis points. It's just a gradual, I'll call it, think of it as the Cape Town's tabletop mountain, right? Like we're going to have that flattening of the credit cycle as opposed to something a bit more spiky. And I think that normalization in credit is happening at a time that expenses are feeling the persistent impact of inflation. I think most of the banks will say that concept of the great resignation certainly didn't live there too long. And so a lower attrition rate is resulting in some banks also having to take action around rebaselining their expenses, certainly as it relates to their staffing levels. And then, of course, we've had this coordinated effort globally by central banks to fight inflation, slow down the economy, and banks tend to be levered plays on the economy. So the revenue environment has been a bit more subdued, whether it's slower loan growth, now the lagged impact of higher rates, hurting the bank's funding costs and the net interest margin, or this really prolonged period of it's cyclical, but one of the longer cycles we've seen in capital markets type businesses, new issue and capital expenditure plans and the like. And probably all of that is going to be less of, I want to be clear that we're not saying it's time to back up, but it's certainly back up the truck. But it feels like things are increasingly priced in, and so we believe that we're at an inflection point, and inflection points usually tend to be points of minimum, not maximum confidence. So I suppose even since last set of podcasts we had here, I think we're less negative when we think about the outlook. Maybe I'll just finish it off by saying I'm a race car fan, so think of it as a pit stop we're going into over the next couple of quarters. They're an important and necessary part of the race. Some will have easier pit stops than others. If you've done your capital allocation decisions in the past, you come in, you are focused on getting the benefits out of your expense initiatives, make sure you don't have any undue risk, and you're looking forward to rejoining the race as soon as possible without kind of messing up the pit stop. Some banks will have maybe a time penalty assessed to them. We think TD may actually still have to deal with this Department of Justice type issues, which will probably be a bit of a time, call it a delay in capital allocation. Some banks may have to do more than just a tire swap and refueling. In the case of Scotiabank, there might be a bit more involved. You may have to change the nose as well, and so some of the banks will have different issues, but we think the race will they will rejoin the race, and when they rejoin the race, I think as investors look beyond 2024, things will look a lot more interesting to them as we sit here right now.
No, thanks for that, Sohrab. And you sort of mentioned early on as well that Scotia, in terms of the earnings, was the low point, and that if you look at the market reactions, that clearly reflected that. And Chris, it's a good segue into our discussion because you actually mentioned, I think, in an email you sent out to ourselves and our team, that you had a chart showing the daily price performances of all the banks when they came out with their earnings, and the vast majority of them were quite positive, which is interesting because actually, Chris, if you bought the BMO Equal Weight Bank ETF ZEB at the highs back in February, we all know you are still sitting on some paper losses. And yet, what's interesting, if you look at our flows in our ETFs, ZEB is the number one ETF in net inflows this year. I think we've seen over $1 billion as of the end of October flow into that ETF. And I do suspect, Chris, that a lot of those flows, those inflows, are driven by tax loss selling. We haven't talked about tax loss selling on this call. I'm wondering if you can sort of describe the process of tax loss selling and why ZEB is a great tool to use to harvest losses for tax
Sure,
purposes.
for sure. Thanks, Dan. And yeah, good to be here again. It's really ETFs can be used. As very efficient tax loss trade vehicles to take on, put off exposures. What is a tax loss trade? Obviously, if you are holding something that's in a loss position, if you sell that asset, you have to stay out of it for 30 days. You can realize a loss and crystallize a loss that can, offset some gains, perhaps in another side of your portfolio. And, with the S&P is up 19% this year, perhaps you have some gains, in other sides of your portfolios. I think banks year to date they've now carved out a positive return year to date, which is nice to see. And I think, comment on the inflection point, definitely can apply there. So, but yeah, I mean, Dan, as you mentioned, ZEB is the top equity ETF at BMO. If you add ZEB and our covered call Canadian banks at WB, over $1 billion. So investors have come in this year. Perhaps they're sitting at a higher cost level than where ZEB is trading in the market. ZEB is trading in the $32 range as we go to taping, 32.50 or so. Hit a high of 42 several months ago. So there has, perhaps if you're sitting on a paper loss, the ETF is a great vehicle to do that. We would always obviously say, an investor should consult their own tax advice prior to doing any trade. Just something to bear in mind that going from one ETF to another, where those ETFs track the same index, generally that would not be considered a disposition. So that's one little nuance. But if you're going from, say, single banks into ETFs, that would be a disposition, and vice versa. Going from ZEB to ZWB and back and forth would be a disposition as well, because you're going from that underlying equity strategy to a different strategy, cover call. So yeah, ETFs provide a great tool to take advantage of that. And perhaps as we look out and with an inflection point, and certainly, like you said, Dan, the market sentiment was pretty good on earnings days. And even Scotia, which was the negative one, I mean, it had recaptured all that it lost in about 3 days after the earnings announcement, which I thought was kind of remarkable. So as banks perhaps, over in the next quarters to come, look like they're going to be doing better, there is an opportunity to harvest and lock in a loss now, something investors could look at and crystallize that loss and reset their exposure going forward.
Thanks, Chris. Appreciate that. Yeah, and I love your point about the ETF is a tool. We often talk about, and look, at the end of the day, an ETF is a tool to use alongside your cash securities. It's a low cost delivery vehicle, and as you start getting into this time of year, that the tax loss selling or tax loss harvesting is a great way to use that ETF. Sohrab, I want to come back to you for the next question, and I want to come back to the issue that we've talked about on many calls, real estate and the banks. You noted, I believe, in one of your reports that much of Scotia's EPS miss was the result of higher provisions for credit losses versus your estimate. I think the big question that many people have, and you certainly see it in the news these days, is how buffered are bank profits from losses on the mortgage book?
Well, I mean, I totally understand investor angst when it comes to mortgages and the Canadian banks in particular, because it is the largest proportion of their loan book, right? So I think across the group, we're talking about 1.7 trillion plus or minus. That probably means 50% of their overall loan portfolio, 25% of their assets. So it's a very important and prominent part of the balance sheet. And if you are worried about higher rates, ability of borrowers to roll over their mortgages at renewal. Remember, in Canada, one of the things we have, which is a little bit different from the US, is we have typically 5-year term mortgages. So by definition, the book will reprice over a 5-year plus or minus, time frame. Whereas in the US, some may be sitting with, low mortgage rates that still have 15, 20 years, so to speak, left on them. So the concern is valid, but I think one of the things that we have historically seen with this asset class or this loan portfolio in the Canadian banks is a variety of features that make us believe in the probability of outcomes. Any of these worries are quite still far out in the tail of the potential outcomes, right? So we are a recourse country. The loan to value associated with these assets are at inception usually 80% or lower, certainly given the seasoning of the book, both in terms of principal and interest payments, but also in terms of house price appreciation. Maybe the effective loan to value, if you think about it on a back book basis, is still in the 50% range, depending on the bank. So the worry when it comes to the banks, I think initially is always that, wow, this time might be different and there will be a spike in loan losses and the banks will have to reserve quite substantially more than what we're used to, maybe similar or akin to the circumstances that transpired in the US with global financial crisis and the subprime lending situation that they had. But then once the cooler heads, so to speak, prevail and there is an assessment of the risk and the probability outcome of those risks, then it becomes more of an income statement consideration. All right, if we have slower loan growth elsewhere because the consumer is going to be responsible towards refinancing the mortgage, then does that contribute to a slower economic activity? We'll have to drive the car one more year. Maybe we take fewer trips. We're not going out for dinner as much. Some of that discretionary spending, which contributes obviously to the vibrancy of the economic activity, will be a bit more subdued. So we think that's more the case. I think if you look at Scotia and quite candidly, all the other banks this quarter would have, to varying degrees, told you that it's more the outlook for the Canadian consumer, but not in the mortgage book, but more so on the unsecured stuff, credit cards and unsecured personal line of credit, which there is a greater propensity to fall behind on than on your mortgage payment. So some of those are being are attracting attention, and I think appropriately so, being preemptively reserved against. I think in the case of Scotia, it was most pronounced. But remember, we don't worry so much about a single quarter move, but we kind of worry, we look at where have we ended up, right? And where we've ended up is the banks now have allowances for credit losses. By our estimate, at a bank like Scotia, those allowances on a risk-adjusted basis relative to the loan book that they're running is probably very conservative. Should give them some breathing room in the coming year. But I think all the banks are actually, well reserved for the risk they're running. That doesn't mean to say they won't have to add to their allowances, but we don't think there's going to be a shock coming at us. And so as you know, as the sentiment to risk has improved, you've seen over the last month or so the Canadian bank stock prices have kind of reacted favorably. But from a valuation perspective, whether it's price to book, price to earnings, I think the valuation level, let's say on the Canadian bank index, is still around the levels we would have seen during COVID pandemic peaks, during the global financial crisis. And those would have been, in their own respective ways, 1 in 100 year type exogenous events that really tested the viability of the system and, you know, questioned the viability of the businesses. So we are totally comfortable that that's not a concern this go around, certainly given the level of allowances. And so I find it interesting that we have much better capital levels, much higher reserve levels, probably better liquidity position, yet we're trading at the types of levels we were trading at, albeit in the last few weeks, we've had a bit of a reprieve on that at levels that we were last trading at, you know, during those 1 in 100 type year events. And so I think we are starting to, again, we're not backing up, like I said earlier, but we feel like we are at near that inflection point. And I think the quarter's results actually were helpful in insofar as it allowed, I think, investors to say, well, maybe, you know, there is a slowdown, but a slowdown does not necessarily mean a death blow, if you will, from a balance sheet perspective. And if they can handle the income statement, and I think as we get into some of the questions, you know, as we start looking beyond 24 and into 25, I think there is a favorable kind of there's reasons for optimism.
And thanks, Sohrab. And it's, you know, you talk about these inflection points, and typically at inflection points, you can have, you know, markets bounce around a little bit. You can have some flat markets as well. And I know, guys, we've spent a lot of time talking about, you know, one of the benefits of the banks, you know, during flat markets is the dividend yield. Now, Chris, I want to come over to you because we recently launched a series of what we call defined outcome ETFs, one of which is the BMO Canadian Bank Accelerator ETF. The symbol is ZEBA. An interesting product if you expect bank stock prices to be flat. Maybe can you talk to us a little bit about how this product makes sense in that kind of environment if you do think bank stocks will be flat for a little while?
Yeah, and I would say, you know, I wouldn't say flat so much as I would say moderately bullish. And but let's get into it because you know the segue of you know improving outlook, you know, suits this style of this product. So you know what these are, structured outcome ETFs, using options to get a little bit of a different return stream. And so we launched some on the defensive side, but this one is really more on the dialing up return side. So, you know, sometimes we see, you know, investors will consider using leverage in the portfolio. Obviously, the leverage is a double-edged sword, to the upside and to the downside. And the idea with the accelerators is having an accelerated zone where you can have more than 1x returns on the upside, but not take any incremental risk on the downside. And so, how this is done is we start, you know, in the case of ZEBA, we own ZEB, so we own that underlying ETF. We collect the dividend yield on that ETF, which is a major source of return with Canadian banks. Then what we do is we use the options market to modify that return stream, and we purchase a call option at the money, and that provides another source of upside exposure. And to finance the cost of that purchased option, we sell two options out of the money, and those two options will create essentially a cap on returns. But those two options that are sold will offset the cost of that more valuable option purchased. So what you end up with is, you know, a strategy where you have, and I should say we do this on a quarterly basis, and it continually resets every quarter. We just launched it. It's going to come up to a reset date at the end of December, and then we're going to reset again out towards the end of March at that time. But yeah, the overall the payoff profile is one where if you hold it kind of through, if banks go down, you would have the same downside as the banks, so call it 1-to-1 downside. But if banks go up, there's that potential to have returns in excess of the underlying banks, because especially if they're in this accelerated zone between where you start, so where that call option was purchased, and between where those two call options were sold. In that accelerated zone, you can have more than 1x returns, and in some cases up to 2x returns, if it's within that zone. Of course, what you're giving up is if banks rally, say, substantially, they would go through that cap, and then you would forego on some return, if you had a real substantial return. But it can be, again, it's an interesting way to elevate returns without increasing risk. In markets like November, where ZEB was up over 8% in November, and as we talked about, a very, very good sentiment improving backdrop across global equities in general, but certainly had a positive impacts on the banks. Markets like that can help a product such as this, kind of achieve, even greater returns. And so it's a return generating solution, can add a little bit to returns. If banks are up 20-30% in a quarter, you'll be foregoing some of that return. So if you're exceptionally bullish, particularly in the short term, I think it makes sense to stick with ZEB. But in markets like these, where it's a little bit choppy up and down, but perhaps we're turning the corner with Canadian banks, it's something investors could consider.
At the end of the day, it's another tool in the toolkit. I do like that you collect the dividend on it, and it just adds to different ways that you can get exposure to the Canadian banks. Hey, Sohrab, I want to come back to you for the next question, because on our last podcast, you had mentioned, excuse me, that the banks would start looking more interesting as investors turn their attention to 2025 earnings per share. You've sort of alluded to this here, that we're at an inflection point. Can I ask, do you have your 2025 EPS estimates for the banks, and have your views changed on the timing of the recovery for the banks?
Yeah, no, it's a thank you for holding me to account. We actually introduced our 25 estimates as we reviewed the Q4 estimates, or Q4 results of the banks, and my views haven't really changed. I mean, if you look at if you look at the exit velocity for the banks in 2023, each one of the banks would have obviously had their own issues. I feel like everyone's happy to put 2023 behind them. I think as we think about the year ahead, like I said, we think about it as a bit more of a pit lane type situation. We need obviously the benefits of some of these restructuring charges to kind of take hold. I don't think that's going to happen right away, but we will see that throughout the year. I think we need, and I think we're getting a bit greater clarity on the macro backdrop, whether it's rates. I think, I'm not a rates guy, but it certainly feels like the anticipation of further rate hikes has kind of mellowed, and maybe we start getting some of those rate declines. I think that in and of itself, believe it or not, will be good for credit quality. We talked a little bit about the mortgage renewal cycle in Canada, and whether or not lower rates will take some pressure off. Of course it will, and so that will be a net positive. And I think this Friday we will have an update from the regulator in Canada as to where they would like to take the minimum capital requirements. So I think between rates and the economy, and then add the regulation, which really has created a degree of uncertainty, generally speaking, and certainly in Canada with with the minimum requirements, I think those will become market clearing events. I'm not suggesting they're positive or negative catalysts, but it's one uncertainty removed as to where the bank's capital levels have to be. So I suspect as we look through 2024, I don't want to call it it's a transition year, but it will end up being probably a year of two halves. First half still a bit of a lingering effect of what we've been experiencing, but by the time we get to the second half, for examples, banks that have drips on dividend reinvestment plans, that banks that are slowly issuing shares, they may be in a position to actually stop those DRIP programs, certainly stop the discount on those DRIP programs. And so I think as we look through 24 into 2025, there's still lots of unknowns, but with, I think, reasonable and probably not overly aggressive assumptions, we see the banks now getting back from an EPS growth perspective within their medium term target levels. So the banks are generally targeting, 5 to 10% EPS growth, in some cases 7% plus. It kind of varies, but we think in 25 over 24, you could be looking at those sorts of EPS growth numbers, right? And I think it's a little bit of a tough ask to say to someone, hey, today, why don't we price them off of 25? It becomes easier when you've seen at least first quarter results out of 24, which hopefully will be a confirmation as to the types of trajectory we're expecting from them. And so, obviously it's harder to buy something that is levered to the economy when the economy is contracting and the earnings are coming down. It's a lot easier when you actually have valuation on your side. Like I said, I think we are trading at valuation levels that are synonymous with real 1 in 100 year type worries, but we don't have nearly the same sorts of kind of issues with the bank. So if you have valuation on your side and you actually get into a situation where earnings growth is going to be closer to the medium term, and maybe there's even, heavens forbid, there's going to be a risk of, sell side and everyone actually revising upwards those earnings estimates, then I think it lines up well for the bank stock to work, and both in terms of earnings estimates driving them higher and in terms of a bit of a re-rating to take them higher. I think to get to, historically, we would have been, we've done 13 podcasts. I think, probably we would have come back. If you review some of the historic podcasts, we've talked about the typical range being in the 10 to 12 times multiple, for example, on a forward PE basis for the Canadian banks. If you look at our target prices and you look at our 2025 estimates, that points to a bank index trading at around 10.2 times. So I don't think we're being aggressive on the valuation multiple. And I think if we can find ourselves in a situation where indeed the trajectory of events is consistent with how we are forecasting it, then we could actually get non-domestic flows into the Canadian equities, including Canadian banks as well. And then I think, those upper bounds of 11, 12 times could be in play. But even right now with just domestic, primarily domestic shareholders kind of maybe increasing their weights towards the banks on a 25 basis, we think that we could kind of see a bit of a re-rating, as well as then picking still up the dividends. And I should have mentioned that all the banks that were expected to increase dividends this quarter, in fact, did so. So that, I think the commitment to the dividends will be unwavering. And so, you pick up the earnings, you pick up the dividends, and you have re-rating potential on your side. But I think you have to just still be just a tiny bit more patient, maybe call it another quarter or two before, we are kind of the party, so to speak, begins.
Good things come to those who wait, and there's a nice dividend there as you wait. That's for sure. Actually, Sohrab, I want to come back to that analogy you've been using to Formula One racing. Last spring, I think it was, in the wake of the U.S. banking crisis, we talked a little bit about the risk of more regulation coming down the pipeline. And I guess, to use your analogy, that's like the F1 governing body changing the rules completely. Forget about a pit stop. I think it was this week the heads of J.P. Morgan, Bank of America, Citigroup, Wells Fargo, some of the big banks were appearing in front of U.S. lawmakers and Congress to push back on some proposed new regulations. It's also interesting to see, if you look at ETFs like ZUB, the BMO equal weight U.S. Bank hedged to CAD ETF. It's down about 14% year to date, versus ZEB, the Canadian one, which, is Chris, you pointed out, has been pretty positive. My question, and this is for both of you, but Chris, I want to start with you to answer this one, is the regulatory environment in the US really responsible for this differential in returns, or is there something else going on here? So Chris, why don't you start with you?
Thanks, just getting off mute here. I'll let Sohrab dive a little more deeply into it. I mean, I would just say certainly it's a headwind, obviously, and it's a bit of a headwind. It's not something that's going to knock all the winds out of the sails, but it's a challenge. Um, but I think there's more to it. And I'll just kind of maybe just have a couple comments from an overall portfolio and market perspective. Again in 2023, we've had a very, very narrow market in terms of what has worked. So I mentioned the S&P was up 19%. I think if you take something like the top 10 companies away from it, it's barely positive. So investors, obviously, the AI stocks and those growth stocks really carried the flag. I think crisis early in the spring, but as we move through that, and kind of echoing some of the things we said about Canadian banks, I'm looking at some of the valuations on the U.S. banks. They look to me exceptionally attractive. The dividend yield is now attractive on U.S. banks. Dividend growth is happening. Return on equity is pretty decent. So, I think investors have potentially overlooked some other exposures besides tech, and I think U.S. banks perhaps could fit into that. If you look at valuation discounts versus even the S&P 500, which is a tech-heavy index, they've really widened out in the past few years and are kind of almost sitting at the extremes. So I'm not sure if I totally answered your question on regulation, but I think certainly that's a headwind. But I think there's kind of greater investor perhaps inefficiencies or just temporary dislocations. I saw a research piece and not so long ago, and it was just pointing out, you can't have the S&P or broad indexes taking off without financials kind of participating as well, and we haven't really seen that in the U.S. Or arguably Canada. We're just starting to see it now. So so I think, it's something that investors can consider. I always say U.S. banks is obviously a higher risk investment than Canadian banks. You don't need as much of it in your portfolio. There's a little bit of kick there already with them, but when you look at some of the metrics, I think it's interesting. So despite, regulatory challenges, I think, they're worth taking a look at.
Thanks, Chris. Yeah, over to you,
I'll,
Sohrab. What are your thoughts?
yeah, I think I'll just pick up quickly where Chris left off. I think U.S. banks tend to be higher beta than the Canadian banks, so we can't lose sight of that. I do think banking, generally speaking, is a thinner margin business. So you do need, I'll call it, the benefit of leverage to get a decent return on equity if you're an investor. So every time the regulators tighten the screw, the primary area, not strictly, but it ends up being on capital levels. And every time they take capital levels higher, they're basically telling you have to make more return on assets with no benefit, so to speak, from leverage. And I think when you're in an environment, and I think the Canadian banks and the larger US banks, my partner covers those, but the larger US banks would be more diversified. Canadian banks are diversified. So that diversification allows you to weather storms a little bit better than some of the more, let's say, regionals that could be a little bit less diversified. And so I think the regulation in the US and in Canada has weighed on bank valuation, certainly has weighed on investor sentiment. And like I said, we'll look in Canada, for example, to this Friday to see where our regulator takes the minimum regulatory requirements. But higher or not, I think will actually be a clearing event because it's one degree of uncertainty removed. I think investors are worried about a more muscular regulatory environment. I think we've talked about this over the last, on this call over the last few years, that regulators will not let a crisis go to waste. And I think Silicon Valley was a bit of an emboldening of that. But I also think banks know how to deal with regulation, and they will obviously adapt accordingly. And I think investors are becoming a little bit more, they have now reflected the uncertainty associated with the regulation around Canadian banks and the types of multiples they're willing to put on them, right? So So now what we need is, with the newly defined kind of regulatory sandbox, we now need a rebound in economic recovery, a rebound in cyclical capital markets type related businesses. And I think that, that revenue, ultimately, the work we have done, regulation matters, obviously, outlook on rates and the economy and all that matters, from what sort of a discount rate or multiple you want to apply. But ultimately, what I think drives total shareholder return for the Canadian banks, at least the work we've done over time, I'm not talking about one quarter or the other, is revenue growth per share. So, if we're in an environment where the top line is growing, I think it gives you a lot more degrees of freedom to deal with unintended or unanticipated circumstances. We've been in an environment where that revenue growth has not been there, at a time where cost of compliance is going up, at a time that regulatory capital requirements are going up, at a time that, like I said, inflation is allowing or disallowing for positive operating leverage because expenses are growing faster than revenue. So, I think if we just get through this part of the cycle, and I hope we're right, and we are in that kind of pit lane and we're coming out of it, then we are going to start talking about growth again. We are going to worry about not just the next 6 months, but 12, 18, 24 months. We really have to visualize where we're going to be 12 months from now, 18 months from now. That's where the prices are going to be. And I think, again, maybe we're being overly optimistic, but I'm cooling our kind of enthusiasm near term. But I do feel like we're going to rejoin the race, and this is going to be a cyclical downturn as opposed to a catastrophic one. And as we make it through, the banks that have been able to deploy capital will probably be better positioned than the other ones. But all of the big six, we expect, are going to rejoin the game or rejoin the race, and probably towards the second half of 2024 and beyond.
I think that's a great note to end on. Clearly, there is an inflection point here. I love your comment about being less negative. And then, Chris, your comments about, look at the market reaction in terms of the prices. And, typically we know markets climb a wall of worry. So I think that's a great way to end this podcast today. Chris and Sohrab, thank you very much for your insights again today. As a reminder to the audience, you can get exposure to Canadian banks via ZEB, which is our BMO Equal Weight Canadian Bank Index ETF. You can also get exposure via ZWB or ZEBA, the new product that Chris mentioned earlier. And you can get exposure to our US bank ETFs via ZUB or ZBK. Those are the BMO Equal Weight US Bank Index ETFs. If you have any questions, please visit the ETF Center at bmoetfs.com. That's all for today, folks. Thank you for tuning in, and please join us in mid-March for the next update on Canadian banks.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.